Welcome everyone, and thanks for joining today. My name is Eric Jones, and I'm the Global Head of Product Management for the Thomson Reuters Wealth Management Division. At Thomson Reuters, I'm responsible for designing and developing our front and back office wealth management solutions, which include our Thomson One desktop for financial advisors. About a year ago, I became involved in developing a relationship between Thomson Reuters and PriceMetrix, who is our co-host for this call. And we're really excited to have this relationship, and specifically to be offering PriceMetrix pricing intelligence information to all of our Thomson One Beta Link users on our desktop. Another element of our partnership that I'm excited about is all of the thought leadership that PriceMetrix provides to the wealth management industry today, and specifically information that helps advisors make more intelligent and informed decisions about how to manage their business. So on our call today, we're going to share some interesting and insightful research about the future and success factors that really drive advisor production. This research was inspired and really created based on some insight and inspiration from a best-selling book and a movie that some of you may have seen called Moneyball. And the team at PriceMetrix has really unlocked, in my opinion, a set of really interesting predictive measures that help determine and really manage advisor productivity going forward. So for our webinar today, we're going to look at several keys to predicting future advisor productivity and really delve into some strategies and tactics that can empower advisors, people who manage advisors, and really the wealth management firm overall to take action that really maximize their business going forward. So specifically what we're going to look at is industry problems that exist today around business development and recruiting, how firms are approaching the issue of advisor recruiting and what they might be missing, and then specifically what firms can do to more effectively recruit advisors, and then once they're on board, how can you really help manage them and target their performance going forward to unlock the value of those advisors at their new firm. So to help with that, we've got some really interesting data, and I think you'll agree after you see it from the folks at PriceMetrix, and they have taken this data and really mined it and analyzed it in a way that I think all of you will benefit from seeing these insights. So to help with this today, we've got two panelists that are joining me. We've got Pat Kennedy, who's VP of Product and Client Services at PriceMetrix, and Chris Monifo, who's SVP at Janney Montgomery Scott. We also want to hear from all of you. So on the webinar today, you should see an input box on the right-hand side of your screen. Feel free to type in questions at any point. We're going to queue those up for the first 20 minutes or so of the call, and then after we wrap up the presentation portion, I'll be pulling those and we'll get through as many of those as we can. So to kick things off, I'm really excited to introduce Pat Kennedy. Pat's a co-founder of PriceMetrix and really responsible for a lot of the product planning, strategy, and client services at that organization today. He also is involved in a lot of the research and analytics that PriceMetrix publishes, and I think really is thought leading in the industry today. So Pat, welcome. Thanks for joining us, and I'll turn it over to you.
Thanks, Eric. It's an absolute pleasure to be here as well, and thank you very much to Thomson Reuters for making this event possible today. So, quick introduction to our firm. PriceMetrix is a software firm. We provide practice management tools to both advisors and managers. Some describe us as a data aggregator, and to that end, our software works by collecting and aggregating data about retail wealth management advisors. The data we collect comes directly from the back offices of our clients, so we have I would say a fairly granular and a very comprehensive view of today close to 40,000 advisors across North America. That data gives us really, I think, a terrific view on the industry, and we share that view with our clients and prospects through publications such as these. You see Anatomy of Outperformers, State of Retail Wealth. All of these are available on our website at pricemetrix.com. But today we're here to talk about one of our most recent studies, which is called Moneyball for Advisors. And But I think this is one of the more exciting pieces of research that we've undertaken for a couple of reasons. One, for the first time, we're using data to actually predict something that hasn't happened yet. And to me, that's very exciting in terms of sort of future application of data and our data. But second, and as Eric mentioned, we were inspired in our story by the story, of course, the famous book now by Michael Lewis, and thanks to Hollywood and Brad Pitt, the movie. So now just about everyone is familiar with the story. But we were sort of inspired by the story, and of course Moneyball talks about the cash-poor Oakland Athletics who can't compete with the big payrolls of other teams. So they use data to understand the behaviors that drive results, and in their case, results are pretty straightforward. They're looking for more wins. Well, PriceMetrix, that's exactly what we do and have looked to do historically with our data, is really understand in that data set what are the behaviors that drive results. So the question that we set out to answer with the study was pretty straightforward. If you knew what an advisor and his or her book looked like today, could you actually predict their performance 5 years from now? This was the recruiting angle. So if I was assembling a team, just like the Oakland A's, but in this case a team of financial advisors, what are the attributes or the characteristics that I should look for if my goal is to grow? And we're able to test a number of characteristics about advisor books, and that actually became sort of the most interesting part of the exercise, to see which of those would rise to the top in terms of their predictive ability. So to share with you the four characteristics that are most predictive of future advisor production. Number one, current production, especially fee. We're going to walk through each of these. Client size was very predictive. Relationship depth, and length of service. Those were the four. We tested probably 24 different characteristics, and those were the four that were the most predictive of future production. So I'm going to walk you through each of those and some of our findings. The first was current production. No big surprise here. What an advisor made last year is very predictive of what they're going to make 5 years from now, and anyone who's been to sort of a president's or a chairman's club trip would certainly agree. It's often very familiar faces. What was interesting in the study, though, was how production sort of tilted towards fee-based production in terms of its predictive ability. And again, when you think about that, not a huge surprise. I mean, part of the appeal of moving to a fee-based model is that, it's nice knowing going into the next year what you're going to be earning on an asset base. We actually did a study just last year called Transitioning to Fee, and one of the findings was that just the pure economics of that business model are attractive. Larger average account sizes, greater production on an asset base, and one of the conclusions from the study was that those who are actively transitioning to fee are actually outgrowing their peers. So current production, especially fee. Client size was also a very powerful predictor of future performance, but not so much average client size. It actually turned out to be the mix of large and small clients in a book. Now, this was not a big surprise to us here at PriceMetrix. We've actually done studies of the effect that small clients can have on an advisor's growth. We've done a number of studies actually on that. In fact, a couple of years ago, we did a study called Small Household Metrics. And what we were trying to do in this study was look specifically at what happens to small households over time. One of the most common things that we hear from financial advisors is that all small households have money elsewhere. There's an inheritance around the corner. There's all kinds of reasons why a small household is expected to become large. Well, we wanted to look at our data. We had enough data over enough time that we could actually track what happens to small households over time. And in this particular study, one of our conclusions was that small households, they do sometimes become large, but they're in fact 108 times more likely to leave than to become large. a tough way, I think most would agree, to grow your business. What we've done, on the topic of small households or client size, we've actually done some more recent research, which is, I think, really pulling the curtain back on the issue of smaller relationships. In this example, we actually put advisors into buckets at the bottom, so based on the percentage of small households that an FA chooses to have in their book. And you see the relationship between the retention rate of their large households. There's a very positive, very strong relationship between the percentage of small households and the retention rate of large households. And that, to me, is a very powerful illustration of the true cost of small relationships. They take you away from providing the time and attention that your best clients deserve, and those best clients will leave a little bit earlier than they would have otherwise. And the relationship to growth, of course, is that revenue from your top clients needs to be replaced. So you're sort of constantly bailing yourself out of a sinking ship. So having a mix of clients that tilts towards large will definitely help you grow, but also important is the depth of those relationships. And this is something that a lot of people talk about, but often don't measure. It's you hear the term share of wallet occasionally, which is a great concept, but it can be quite tricky to actually measure that. What we did is we actually took two proxies. One was the accounts per household, so the average number of accounts in the average household in an advisor's portfolio, and the other was the percentage of households in an advisor book that have retirement accounts. And it is a fact that deeper relationships stay longer and produce more. We did a specific study just last summer on retirement accounts, and one of the conclusions from that study was that households that have retirement accounts pay their financial advisor more on a dollar basis, and this is roughly on the same asset basis, and they produce revenue at a higher rate. So here you see the number of IRA or 401k accounts in a household, 0, 1, or 2 or more. Very clear relationship between the penetration of retirement accounts in individual households and the ROA of those household relationships. So relationship depth was a very important predictor of future production. And the last was length of service. And we didn't certainly intend for this characteristic to ruffle any feathers, but the way these predictive models work is essentially they hold other variables constant. So if you think about it, and I often use the illustration, if everything else is equal, if I'm looking from a recruiting standpoint at two, let's say, $1 million producers, one of whom has been in the business for 8 years, and the other who's been in the business for 28 years, the 8-year FA is predicted to be bigger in 5 years. Not that controversial when you just think about the time it took them to get to $1 million in production. So I wanted to close off today. It's a little bit more fun to sort of think about this back to baseball terms. From a recruiting standpoint, our marketing department had lots of fun putting baseball players in boardrooms here. But it's not the front of the card that's important. It's actually the back of the card. And I wanted to share with you a couple of illustrations just to bring this model to life. We're looking here at two financial advisors, Skip Johnson and Dustin Wheeler. And if I just run down their career stats here real quickly, on the left, Skip Johnson, $850,000 producer, predominantly transactional, a little bit of trailer revenue, about 400 household relationships, 2 accounts per household, 75 retirement accounts, so not very many when you look at that as a percentage of their household relationships, and they've been in the business for 15 years. Dustin Wheeler on the right, smaller producer, $600,000 producer, fewer households, about 200 in total, but the mix of households is a little bit more tilted towards large. You see deeper accounts per household than Skip Johnson, and more retirement accounts. And Dustin's actually only been in the business for 8 years. And when you look through our model at the total production from each of these individuals, 5 years out, you actually see they're both predicted to be million-dollar producers. So even though Skip Johnson is producing much closer to $1 million today and has been in the business for longer, Dustin Wheeler will catch up in a matter of 5 years. I'll walk through just one more example here, two more advisors, Ricky and Roy, and we'll flip their cards around. Sometimes it's a little bit easier to track these models when you look only at a couple of variables. So Ricky and Roy have the exact same production today. They're a little bit more of a mix of revenue, but the revenue mix is identical for both of them. In fact, they have the exact same number of household relationships in the same mix. But with Roy on the right, you see just about double the relationship depth. 3 accounts per household versus 1.5, and 200 retirement accounts. Both been in the business 10 years. Well, at year 15, Ricky is expected to be producing $781,000 in production, and Roy at just over 1.1 million, 1169. So that's quite a material difference, and you see here that's just about entirely based on the depth of those relationships. So I wanted to conclude just by showing you, and I'm moving away from the model and back into sort of today. This is actually the real distribution of advisor growth rates in the industry over the past 5 years. So from 2007 to 2012, the median is about 30% growth. 10% of advisors actually shrank in their gross production over that time period. And 10% were greater than 50% growth, so quite a range in performance. And I use this because if you're listening and you're an advisor, you are on one of these trajectories. By 2017, potentially this whole curve might have moved up or down, because market conditions can change. But the characteristics that you control determine where you will be on this curve. And I think, if you think about the things that you can do and some of the things from the study that will best position you for future growth, be deliberate in managing the client composition of your book. Certainly focus on the quality of relationships and the fit with your proposition rather than quantity. Look for opportunities to deepen existing relationships and be willing to say no. I mean, those are 4 controllable things that come out of this study. So I think very actionable. And I'll close things off today with, I'd love to lay claim to being the first person that applied these Moneyball principles to financial services. But there's actually a quote in the book, in the Michael Lewis book itself, by John Henry, who's the owner of the Red Sox, and he earned the money to buy the Red Sox through a hedge fund that he was managing. He said, people in both fields, baseball and financial markets, operate with beliefs and biases. To the extent you can eliminate them both and replace them with data, you gain a clear advantage. I really can't sum it up better than that. I'll pass it back to you, Eric.
Thanks, Pat. Listen, really great insight, and I think a great use of data to glean intelligent information. We're fortunate to have today with us also a senior executive at Janney Montgomery Scott, Chris Monifo, who can, I think, give that some perspective in terms of the research that Pat talked about and how he's, as a practitioner and a member of a leading wealth management firm, has really applied some of these views. So, Chris, maybe you could start by telling us a little bit about yourself and Janney Montgomery.
Oh, that would be great. Thank you, Eric, first of all, and thanks to PriceMetrix for inviting me on the call today. But yeah, sure, I'd like to give you a couple of minutes about Janney. We are predominantly a retail boutique. We operate mostly on the East Coast, certainly on the east side of the Mississippi River. We're a retail firm. 80% of our revenues come from the retail side of the business, and we operate in about 100 offices. We've been around for a while. Our roots date back to 1832. And at one point, we owned the oldest domestically owned seat on the New York Stock Exchange, just to give you some sense of how long we've been around. What really makes us different, though, not only from the big firms, but from the other mid-sized firms, is our ownership structure. We are a non-public, wholly owned subsidiary of a mutual insurance company. That is Penn Mutual Insurance Company. And that really gives us the opportunity to operate without the pressures of associated with public ownership and quarterly earnings estimates, et cetera. And a lot of the management in the private client group here has sat in the seat of the financial advisors. So we also have, a longer term focus on the business. But my role really started in 1984 as a trainee. I was an FA for 10 years and then a producing branch manager for 10 years. And then I moved to Philadelphia to become a regional manager for the South, which ironically starts in North Jersey for Janney, but it does extend down through Southern Florida. I'm now the Director of Private Client Group Administration, which is really like the Chief Administrative Officer for the Private Client Group. But on the sales side of the business, in a firm this size, the term administration is really a misnomer. My job more than anything else is to improve or increase revenue while always improving the FA and the client experience. And there are three main ways that I do that. Of course, I head up the recruiting process here at Janney, which is responsibility for home office visits, due diligence, offers, things like that. But it's not all about recruiting. What happens when an FA and a client comes to Janney? Professional development reports to me, including the desktop tools, the relationship with Thomson Reuters, for example, practice management specialists, developing our national conferences. We also act as a liaison with the different support groups like operations and compliance, just to make sure that the noise to the field keeps to the minimum. And when there is initiatives out there that need to get out to the clients and the FAs, that they are communicated and executed well. So I think that sums it up. Eric, back to you.
All right, Chris. So maybe let's talk for a few minutes about Janney, and can you tell us about how you guys think about recruits for your firm, and specifically, how do you gauge whether they're going to be a good fit with the Janney culture?
That's a good question. I've been recruiting for a long time. Way back when, I remember that the only requirement you needed to have to be a good fit is being able to fog up a mirror. But that certainly is not the case anymore. And what we typically look to do here is always improve our FA metrics. So right now, our typical or average FA gross is about $500,000 per year, and on about 75 million assets under management. So what we want to do, first of all, is target production above that. So we're looking for production of at least $500,000 a year, 70 million in assets plus. Just to give you an idea, though, for 2013, we've been on a pretty good roll. Our average production for 2013 recruits is 800,000 on 100 million in assets. But I think what's important is not only looking at gross production, trends, for example, over the last couple of years, assets under management. What's really becoming important, though, are things like the number of accounts. Is the FA paying attention to client segmentation, which is obviously very important? The number of IRA accounts. Can we judge the depth of relationships, the level of cross-selling, and the depth, and the size of the relationships? And of course, one of the most important things that we look at, we take a very close look at business mix. All right, of course, we have standard deals in place like most other firms do, but depending upon the specifics of the due diligence that we uncover, we can be very flexible. I'll give you one example. Last year, we took in a top FA, very high-profile fella. His target this year is to produce $500,000 in fee-based revenue per quarter, just in the fee-based revenue. He has a shorter than average length of service in the business. We talked about that just a little while ago. He has only about 100 relationships, deep relationships, obviously, to generate that kind of revenue. And of course, it's a very effective or efficient practice. He's only got one PCA, so this is a low-cost, high-potential practice, and obviously, willing to be more flexible with an FA like that. Eric?
So Chris, so that's good feedback, and I know from our experience, we've seen the Thomson One desktops increase at Janney, so I know you all are being successful with your recruiting. Maybe you could draw some linkages between what Pat talked about and some of that insight and things that you may be doing differently recently based on some of that insight.
Yeah, sure. Well, we're very proud to say that we've been a client of PriceMetrix for quite some time. I think it dates back to 2004. So when we saw Moneyball, we were very intrigued by that. We agree with a lot of it. And quite frankly, we've been working in a lot of the topics that were surfaced, again, in that paper. And I'll give you an example. We embraced the idea of growing household size and segmentation early on, as I'm sure most of the people, or a lot of the people on this call have. But since 2006, I'm very proud of the progress we've made. we've been able to increase the number of millionaire clients here 38% since that period of time, while at the same time reducing the small households by 43%. And I think more importantly, when you look at an average FA, that takes the average household for FA down from 230 households to 178 households. Now, we still have some work to do, but you have to keep in mind, though, that we were able to do all this while increasing overall production and assets under management.
Well, that's great. So last question for you. Any advice that you would give open-ended to either firms that may be on or advisors themselves about how to really grow their business and unlock their value?
Yeah, yes. In 1984, when I was a trainee, I'll never forget what my branch manager told me, and I believe it's true today. He said, the best thing about this business, Chris, is that there are so many ways to be successful. And I believe that that's still true. And we've talked about fee-based revenue and everything else. It's getting off to a good start. And it's all about hard work and working with integrity. The other thing that I would say, and part of my role here, is to listen to your best clients. Segmentation is all about providing the best level of service and pricing to your best clients, in my opinion anyway. Listen to what they want and give it to them, right? And lastly, as I just shared with you, segmentation works. Not only does it remove clog, but from an FA's point of view, when I was sitting in the seat of an FA, it got me there would be nothing that I would want to do less than give up any kind of client or any kind of asset. It took me a long time to understand the concept of segmentation, reducing the clog, and freeing up time to work and deepening your relationships with your best clients.
Great. Well, Chris, I think that's terrific advice and very well said. So thank you for those comments. We're kind of running up against the time here, but let's try to squeeze in a few questions. Feel free to type in the input box in the webinar. We've got a couple here that have come in, so I'll fire away quickly and we'll see how many we can do. This first one is for Pat. Pat, can you tell us what other factors were strong predictors in future advisor productivity?
That's a good question. I mentioned we tested a number of measures. We would have loved for pricing to be one of the top predictors, but it didn't make the top 5. And when you think about that, the price that you choose to charge has less of an impact on your future production and much more of an impact on your current production. But there were other measures around client size that were predictors. They didn't necessarily rise to the top of the list. One of the things I always tell people is that we're limited in these studies to testing what we can actually measure. And one of the things we can't measure is hard work, for example. The characteristics, the 4 characteristics that I described have an R squared, I believe it's called, of 80.81, which means we can predict 81% of revenue, future revenue, and that leaves a lot. The 19% would be impacted by a number of other things. Hard work, for example, can overcome a number of those measures, and I think that's an important message for advisors is, just because you may not score as highly on these 4 characteristics, or you may be a little bit further into your career, there's an awful lot of things that you can do to overcome any shortcomings in the things that we did measure.
Great, thank you. Similar related question for Chris. How does an advisor's length of service factor into your professional development and business planning? For example, is there anything practical that anyone can do about it as being a predictor of success?
Yeah, length of service is one of those things when you're asked that question, what keeps you up at night? I'm concerned always about the lack of new people coming into this business because, how difficult it is to develop a new book of business. But I would say that, people with short length of services that at least get off to good business practices, that stay on track, sticking to some of the topics we talked about today, are much better candidates for, team to match up with senior team members, as an example. At Janney here, we're always looking for shorter length of service people to move in and work with retiring FAs as successors for our transition program. That's number one. And then number two, of course, we're seeing a lot of teaming going on, obviously with the complexity of the business these days. Providing expert advice and being an expert on everything is hard. And we're also seeing a lot of parent-child teams coming in, so we're definitely promoting that. And we're also putting together professional development seminars for junior, senior team members focusing on things like fee-based revenue, segmentation, and growing existing relationships. Back to you.
Okay, great. Thanks, Chris. Listen, let's take one more. I think this will be a quick one, and we'll direct this one to Pat. In your research, Pat, how did you define a small household?
Yeah, great question. So the study itself, which I'll mention one more time, is free for your access at PriceMetrix.com, defined the small, large threshold at 250,000. Now remember, it was really the mix of those, so that's a relatively high threshold. I used two exhibits in today's presentation, which were from that small household study from a couple of years ago, and a small household definition then was $100,000. But Moneyball itself set the threshold at $250,000.
Okay, great. Thanks, Pat. Well, listen, everybody, thank you for your time. I think we're going to wrap up. I want to thank again Chris and Pat for joining and providing some excellent insight today. Hopefully everybody enjoyed that. We will be sending out the slides to everyone that attended and registered for the webinar within the next few days. And then as Pat said, PriceMetrix is very open about distributing their information, their research, so you just need to go to their website, PriceMetrix.com, and you have access to a lot of information, and I'm sure ability to contact folks if you'd like some more. So thank you all very much for joining today, and everybody have